So
$20,000 reduction in interest.
Absolutely. You sacrificed free cash flow in order to save $20,000 in interest.
All right. Welcome back, everyone, to the Financial Philosophers podcast. Danny, excited to be chatting with you today.
Yep, as always.
We're going to shift gears on the topic of debt because, Danny, you and I have been talking a bit about debts lately. Episode 5,
just a little bit.
Talked about... Hey, they're a good thing to address. A lot of people are dealing with it. Yep. And, we've been focusing mostly on like the rationale behind making additional payments or why one would want to pay down debts more aggressively if their situation makes sense for it. We talked about in episode 5, the debt repayments as an asset class. We even talked about credit cards in episode 6 and even mortgages on the previous episode 11.
So many debts. Yep.
I know. But I realized that we hadn't talked about refinancing debts, which is a different topic, right?
Good call out.
Yeah, a couple nuances there.
What happens when you want to adjust the debt and you aren't able to get rid of it just quite yet?
Yeah, and there's definitely a few things we have to explore on that topic. So I thought it would be worth exploring that today. You might be thinking, why might I refinance, right? There, in general, and we're going to explore both of these reasons, there are generally 2 primary reasons. One would be to save on interest, right? You might have a certain interest rate. You know how much interest you're going to be paying over the life of your loan or whatever your debt is. So you might want to be tackling that in some way with a refinance. The other reason is you may need to just free up cash flow, right? Your monthly debt obligations might be at such a level that is causing strain on your ability to meet other living expenses or to save for other goals, perhaps. There could be many different reasons. Those are the 2 primary reasons. There are other nuances we need to be aware of as well that we might touch on a little bit here and there, like whether you refinance to a fixed interest rate or a variable interest rate, whether there are any costs associated with the refinance,
absolutely,
how your credit score can play a role in that and whatnot. So, but
I have a little bit to say on this actually.
Cool.
Because we refinanced a couple of years ago for both of those reasons. Both to
Are you
save
talking
on
about
interest.
your mortgage?
Yeah, we refinanced our mortgage.
Your enviable
2.75 now. Yeah.
Oh my gosh.
We refinanced to both save on the interest and free up that cash flow, just so that we would have a bit more flexibility, in our monthly budget. And there was a refinance cost, and we'll talk about that as well. But our original mortgage, it was a 4.75% rate. And when we refinanced, we went down to a 2.75, so we dropped 2 full percentage points there.
Nice.
And that drop saved us approximately $500 a month in interest.
Wow. So $6,000 a year in interest, right? Just from a refinance.
Yes.
Wow.
Now, the refinance itself cost, I think, in total about $5,000. And so we broke even after 10 months.
Yeah, not even a year.
Yeah, it was not
nice.
bad. So the savings on interest, we broke even on that initial refinance cost after only 10 months of paying that back. And that $500 that we now have in free cash flow gives us the flexibility. We roll a lot of it back into the principal. So we are still paying closer to what our previous mortgage payment was. But instead of being wasted on interest and going towards the lender's bank account and their wallet, right, it is instead paying into our equity within the property. And
nice.
it's a really nice feeling. And like I've mentioned in the past, that lower minimum payment, since we did do another 30-year, that lower minimum payment allows us to dial back on our overall mortgage spending in case of an emergency. But we've been very happy with it.
If you need to dial back, though, because from my understanding, if I recall, you are making slight additional payments.
We're making additional payments on the principal every month. But in case of an emergency, we will dial back to the base while we resolve whatever emergency is going on.
Nice. I'm curious.
The thought process there.
What when you had your original mortgage at 4.75%, how long were you paying into that mortgage before you refinanced?
Approximately 5 years.
Okay. Yeah. So you refinanced into another 30 years. So you'll essentially, in theory, if you were making just the regular payment, you would be paying off your mortgage in 35 years.
Correct.
But despite that fact,
we are actually going to be paying this off early. So when you consider the 5 years we already put into it, we're probably looking more at about 27 years.
Yeah,
in total. And that's with our current rate.
I obviously don't have the numbers in front of me, but I'm curious as to whether, even if you did pay it off in 35 years, I'm wondering if you still would have paid less in interest due to the refinance anyway.
I believe so, because we are putting more towards the principal and lowering that overall principal that accrues interest more aggressively.
Nice. That's really cool. That's like it's almost like a best of both worlds where you're both saving on interest and freeing up cash flow.
Yep.
Yeah, I mean, to our listeners, obviously, I'm like smiling when you gave that example, because a 4.75% mortgage would be really nice in today's
true
numbers. So I'm like, wow.
That's why I say we're never going to sell this house.
Yeah, probably when you took that original mortgage, you're like, oh my God, 4.75% so high. I can't wait to refinance. But then you think about today's numbers. So, to our listeners, we're gonna jump back into these primary examples: saving on interest and freeing up cash flow, which you just showed in your example, Danny. You achieved both in one fell swoop. It's hard to say on whether you'd be able to do that in today's environment. It just totally depends on what debt you're refinancing and what the situation looks like. But we're gonna dive into both of those reasons. So the first one's going to be saving on interest, and trying to determine how valuable a refinance might be. If you're just focusing on the interest piece, we're going to put the freeing up cash flow aspect aside for a minute here. So for this reason, saving on interest, you want to look at your current interest rate and then just look at what your new interest rate would be and simply subtract one from the other. And you can see the spread. Danny, in your example, it was 2%, which doesn't sound like a lot, but that's actually a very meaningful reduction in interest, especially when you're paying off a loan over many years.
So something to keep in mind is when you are dealing with dollar amounts in the hundreds of thousands, small percentage changes have a very large effect over time.
Yeah, definitely. I actually have a personal example for you and our listeners today as well. So it's a little bit different than yours, and there are a couple observations we'll make from it that are a bit different from your situation as well. So my wife had a private student loan from her second bachelor's degree when she was doing her BSN, and there was a private student loan because she actually didn't qualify for enough in federal loans to cover the full tuition bill at the time, so we took out some private loans on top of that, and the original loan amount was $33,680. So when she graduated and she got a job as a registered nurse in labor and delivery, we had the option to refinance that private loan. And at the time, we had selected the longest repayment schedule because she was in school. I was single income. I was also working on my own career, so my income was much lower than it is today.
Yep.
And so we really needed that additional cash flow. We chose the longest payment duration, which was 15 years by this private student loan provider, and the interest rate was about 7.5%. So I know,
that
pretty
hurts.
high. And that was back in 2018. Like, rates weren't even where they were yet. Like, so it was very high for that time. Yeah. But we chose the longest duration, 15 years, because we really needed to make sure we had enough free cash flow to address other goals. And when she graduated, got a job, we were looking at the loan and we're like, this could be a clear candidate to refinance. Because if we kept it where it was, we'd pay $312 a month for 180 months, which is 15 years. But what we ended up doing is we refinanced that from a 15-year at 7.5% interest to a 5-year at 3.335% interest.
Okay. Lower interest rate, but far more aggressive repayment schedule.
Yes. And so you'll probably see where that's going. So we more than cut the interest rate in half, right? So there's over a 3 point, So we actually cut that interest rate by over 4%. It was about 4.16%.
Yeah, that's such a huge drop.
Big drop for sure. So the original payment was $312 a month, but we would have paid $22,519 in interest.
Yep.
So, that's it's almost, it's not quite doubling what the original loan was, but it's getting up there, right? You're starting to push into that almost to $60K total pay.
You would have
right?
paid another 2/3 of that loan just in interest.
Yeah. Now with the new loan, it almost doubled our monthly payment from $312 a month to $610 a month, but we're paying it off in 5 years instead of 15.
Mm-hmm.
And the total interest paid over the life of this loan that we refinanced, $2,932.
That's awesome. So
$20,000 reduction in interest.
Absolutely. You sacrificed free cash flow in order to save $20,000 in interest.
Yeah. Yeah,
Nice.
and also pay it. Yeah, and the gratification of paying it off 10 years sooner.
True.
Right.
That weight is lifted off of your shoulders that much faster.
Yes, but you're right. I think you said it correctly. We sacrificed cash flow, right? Like that is the trade-off in this situation. We have less cash to deploy elsewhere, and there are also a couple things that we need to point out too. One, and I did reference this in a prior episode very briefly. Our debt to income ratio became slightly less attractive, right?
Yeah,
because
your monthly debt obligations are higher. Okay.
Correct. Yep. So if we were, applying for a mortgage, for example, that depending on how high our income levels were, that could have been an issue.
But
the other thing,
correct me if I'm wrong, but I believe you knew you weren't going to be buying a house in the next 5 years.
Oh
so
my gosh, yeah,
your belief was that you will have this paid off before you are considering buying any home.
Yeah.
Okay.
As you recall, Danny, and any of our listeners who've heard our prior episodes, where I was talking about my personal life. My wife and I moved 12 times in the last 10 years of our relationship. So we were very much not anticipating settling down just yet because we were working on careers and education. So yes, that's correct. It's good to be mindful of those. So anybody who is looking at this as an option, just be mindful of how it might affect your debt to income ratio. The other thing too is we had to increase our emergency fund, right? So our monthly debt obligation over doubled, right? So we had to build that in terms of monthly expenses we need to replace if we lose an income. So the demand on our emergency fund also increased because of that. So, going from a 15-year to a 5-year repayment, it makes it difficult to do an apples to apples comparison, right? If it was going from a 15-year to a 15-year, it's much easier to go, oh, I'm saving this much on interest and my payment decreased by this much.
Definitely.
But the 5-year, paying it off in a third of the time, kind of throws a little bit of a wrinkle in it. So it can make it difficult to discern, like, is it worth doing? To us, the reduction in interest rate, by 4.16%, and the reduction in years that it takes for us to pay by 10, and the total interest saved by over $20,000 or close to it, that all of those reasons were compelling enough for us to go for it, despite the fact that we're doubling our payment and those other reasons I mentioned. So
yeah, that makes a lot of sense.
Yeah. And again, to reiterate, it might be difficult to get such a meaningful interest rate deduction of 4.16% in today's high rate environment. I haven't checked student loan interest rates or other rates. I'm not totally up to speed on all of those, but other reasons that might be compelling for somebody who's trying to save interest. If your refinance option allows you to keep the payment exactly the same as what you're paying now, but pay it off sooner, that's a compelling reason to consider, right? You're not changing your cash flow, but you're paying off this debt potentially sooner by refinancing. That could be something to consider. Another compelling reason would be if you're able to decrease the amount you have to pay, but still pay it off in the same amount of time that you are currently on schedule to pay it off. That could also be another compelling reason. And both of those.
Depending on the debt, you talk about paying it off sooner. If we're talking about, say, a mortgage on a home, even if you refinance and your monthly payment stays the same, but more of it is going to principal, you can almost view that as a form of forced savings, right? Because you are building your net worth as you increase the equity in your home.
Yeah, that's a great call out there. And we should actually put that as another positive reason to consider decreasing the amount of time you take to pay off your loan. In this example, I will admit it wasn't the motivation behind us doing it, but
Sure,
to our
not
listeners,
for your example.
but I think in my example, increasing the monthly payment by almost double, like you said, is actually a good way to force savings, right? Like, so to our listeners, if you're somebody who, again, struggles to hold on to cash, just not a good saver, right? And it's okay, it happens. Some people struggle to save. This could be a method you could employ if you have debts, a mortgage, student loans, things that you could deploy cash to. Very prudent thing to deploy your cash to. Choosing to up the payment in a forced way, such as refinancing to a shorter repayment schedule, that could be a good method to force savings habits on yourself.
Definitely. The one call out that I think I would caution against would be if someone has trouble saving and is a spender. If you are going to be taking these actions and essentially locking this cash flow into the debt repayment, which I truly do believe is a great thing, and paying off your debts and becoming debt free feels amazing, and it takes a weight off your shoulders. But if you are someone who struggles with spending, I think there might be a risk if you don't get the spending under control and you lock away the cash flow, that spending is then done on additional debt. And so that's something to keep in mind.
I 100% agree. That's a good point. And so yeah, to your point, Danny, take your personal situation into consideration before you make that decision. Just another quick call out though. A lot of people hesitate to throw money at debt because they feel like, should I be doing something different with my money? I just want to remind you that paying off debts does increase your net worth. It literally grows your wealth the same way that saving or investing does. It always boils down to the bottom line, which is your net worth.
Assets minus liabilities.
Yep. And so it's a prudent thing to throw your money at if it makes sense for your situation. So, but yeah, so on to the second reason, primary reason somebody might look at a refinance. This is going to be more in line with the need to free up additional cash flow, right? So you might be in a situation where you're struggling with cash flow, you're struggling to meet certain bills or expenses. Maybe you have a really important savings goal that you need to be funding. Whatever the case might be, if you are struggling to do that because certain debt obligations are just too high and aren't fitting comfortably in your budget, that's another reason you could look at a refinance. Lowering the interest rate is obviously going to help if your payment schedule stays roughly the same, right? Because paying less interest is going to decrease your monthly payment obligation. Also extending the repayment schedule, right? Like if my wife and I were still concerned about cash flow before we did that refinance, as much as we wouldn't have liked to pay 7.5% interest for 15 years, it did cut our payment in half after all, right? So if we were really tight on our budget, there could be a reason to go that route.
To kind of go in the reverse and do the opposite form of refinancing almost.
Yeah.
Hopefully still getting a lower interest rate, because it doesn't make a lot of sense to refinance to a higher interest rate in most cases. But sometimes there may be an argument for someone to refinance at that longer term if they simply don't have the cash flow and can't come up with that additional money, right?
Yeah. I mean, the best case scenario would be that somebody's able to find, some type of happy medium where the interest rate is being reduced, or perhaps at least not changing, right? Like at the very least. Plus the payment schedule is maybe staying the same or being extended a bit. Finding a happy medium where the interest rate and the payment schedule intersect.
Sure.
Hopefully,
and something to keep in mind is that, to everyone listening, if you no matter what your debt is or what kind of loan or repayment schedule you have, if you have that lower monthly amount, that lower obligation, and you've taken that longer term, even though it will cost you more money, if you work on increasing your cash flow and your earnings potential, you can always put more money towards your debts.
Absolutely.
With the exception, I think there are some things that have an early payment penalty. But I think that's maybe a discussion for another day.
Yeah, I've personally never experienced it myself. I've never
I
had
haven't
a
either.
debt where there was an early payment penalty. But that's something to be mindful of for sure. If you are anticipating a situation where your income's going to improve, your budget's going to improve, maybe like in some short period of time, a year or two after you refinance, and you're hoping that once that happens, you can really hit that debt hard and just knock it out. Just make sure with whoever your lender is, whoever you're refinancing with, if you are going that route, just make sure there's no penalty to early prepayment, just to make sure you have that option available. Just be aware of it.
Absolutely. So go ahead.
Yeah. And I also wanted to, give a quick discussion on fixed interest rates versus variable interest rates.
Okay.
I have personally never had a variable interest rate debt. I've always had fixed interest rate debts, but they each have their pros and cons, right? So obviously with a fixed interest rate, if you're refinancing into a fixed interest rate, you know what that interest rate is. It's predictable. You know that your payment's not going to change over the life of the loan. And so you can plan accordingly without any fear of something coming up to surprise you down the road, right? The variable interest rate may be slightly lower depending on the rate environment, which could be attractive, but there is the risk that if rates change in the future for better or worse, right? There's that element of unpredictability there. And I can't tell you whether rates are going to go up from here more or if they're going to come down. I just don't know.
You're not going to commit and make a prediction right now, Chris? You're not going to say they're going to be at exactly this level 2 years from now?
I don't think so, no.
I think it's a good call.
Yeah. I unfortunately don't have the interest rate crystal ball on hand at the moment. So, but the risk with going with a variable rate is if you get a variable interest rate on your refinance and rates continue to go up, you run that risk of your payment increasing beyond what you were expecting. The opposite could also be true, right? A variable interest rate could come down if rates improve. But you also could have the option to just refinance at that point to begin with, right? So, you may still have that flexibility to take advantage of a lower rate if you start with a fixed rate and then refinance if rates do come down.
Okay.
You have to weigh the pros and cons in that situation. So
but in terms of refinancing and say freeing up that cash flow and that free cash flow causing your debt to income ratio to improve, needing less in your emergency fund because the monthly debt obligations are lower.
Yeah.
What else should we think about in terms of refinancing and different forms of debt?
Yeah, good call out, by the way. Where the example I gave for my wife refinancing her private student loans, our debt to income ratio took a hit and our emergency fund needed to increase. For those of you who are refinancing to free up cash flow, lowering your monthly debt obligations could actually improve your debt to income ratio and also put less demand on your emergency fund. So thanks for calling that out, Danny. But yeah, other things to think about. Depending on the type of loan or debt that you have that you're looking to refinance, there could be some caveats or nuances you have to really be aware of. First one, we'll talk about maybe student loans, right? Maybe you're trying to get on some income-driven repayment plan, or maybe you have student loans where you work in a certain sector or field where if you are at an eligible location for a certain duration of time, you might be able to have your loans forgiven. If they're, public federal student loans. You have to be really cautious with student loans that if you're refinancing them, which generally, doing a student loan refinance means you're putting that money in the hands of a private lender now, right? You might be moving from federal loans to a private loan. You might be jeopardizing some of those loan forgiveness options you might have.
Because technically you've already fulfilled your obligation to those federal loans, those federal lenders, right? Because when you refinance, that initial debt is paid in full.
Yeah.
On my current bank, we have two banks, but one of our banks, they, after many, many jumps, eventually purchased our mortgage. And we had not intended that, but they ended up with it. And when we refinanced, we ended up going with a private lender, and they pay off that bank loan, right? And so now when we log into that account, it literally says mortgage paid in full, even though we're still paying a monthly amount somewhere else. Just a kind of an interesting call out there.
That's
So
really
yeah,
funny.
if you refinance your student loans, you have technically fulfilled your obligation to the federal side, but now you owe somebody else. And so you're
Right.
unlikely to be able to take advantage of that loan forgiveness, correct?
Yes, that's exactly right. You just have to be cautious that you're not giving something up there. Now, the requirements to be able to be eligible for that loan forgiveness are pretty strict. You have to meet certain criteria and satisfy certain criteria. So for some people, for many people, in fact, it's a non-issue because they may not even work in the certain field where they could have student loans forgiven, for example. But if you're one of those people, you really need to explore that first to make sure that you're not sacrificing something that might have been a better option for you before doing a refinance. On the mortgage side, Danny, you had a really good example on that. I think the biggest thing to be aware of there is, like you said, the refinance cost was about 5,000 for
Yeah, for
doing it.
us. Yep.
Yeah. So on that side of things with the mortgage refinance, you'll want to do what Danny did, which is see when that break even is. Like, look at the interest rate reduction, look at the
Yep.
monthly payment change, and when is that break even point where the savings you are getting from that mortgage refinance have surpassed the refinance costs itself.
Absolutely. And
That's
we
a
were
good call
certainly
out.
happy with the 10 months. But
Oh
if you're
yeah.
doing those calculations and you're seeing that it's going to take 7 years to break even, I don't know if you're necessarily going to want to move through with that refinance.
Yeah, unless the refinance was just drastically lowering your monthly
Sure.
payment, and it was freeing up cash flow. But you're right. That is definitely something to be mindful of and to look into before you do it. Also, I think before you can even refinance your mortgage, you need enough equity in your home, if I'm not mistaken. Right?
Yeah.
Did you have to have 20% when you did yours?
I mean, we were already far beyond that, so I'm not sure about the exact number, but I believe we were around 50% equity at that point.
Oh, wow.
So, yeah.
Yeah. Yeah, I
Yeah,
think I
we're
think the situation that would come back to haunt somebody if they're trying to refinance their mortgage is if their home's value maybe decreased since they had
mhm.
done the original mortgage and they're trying to refinance, but the debt's larger than what the value of the home is.
Yeah,
Perhaps like they didn't.
that would be difficult.
I think that's just another thing to be aware of. On auto loans, or like a car loan, for example, I struggled to actually think of much to talk about here, like things to be aware of if refinancing your auto loan. I'm sure there's some weird nuance that I'm missing here where like the original loan provider maybe has some weird stipulation built into the contract about refinancing that could be an issue, but nothing's coming to mind at the moment. There is just one thing that came to mind, and I'm going to give a quick shout out on it, and this is another personal example. We used to have a car, and we had a loan on that back in the day, and went to pay off that loan, and I realized that I had financed in that loan something called gap coverage. So when we bought the car,
Okay.
as soon as you buy the car and you drive it off the lot, it depreciates immediately in value, right? Um, 2020 and 2021 used auto sales apocalypse aside, as we've talked
We're going to be
about.
bringing that up forever.
I know. Uh, so generally, when you drive a new car off the lot, it goes down in value, right? Gap coverage, which some auto insurance providers offer, but others don't. Mine does not. Gap coverage ensures that if you were to get in a wreck as soon as you bought the car, and the replacement value of the car was less than the loan you owe on it,
Okay.
the gap coverage will ensure that once your auto insurance provider pays out a check from the claim for the damage done to the vehicle, let's say it was completely totaled, if it wasn't enough to pay off the remainder of your auto loan, gap coverage would kick in and pay off the rest to ensure that you're not stuck with a loan on a car that just got totaled that you
That's
weren't able
interesting.
to pay off, right?
I guess in a way that almost means that in that first year, that you drive off the lot, that first year you have the car, is the riskiest if you buy a new vehicle, in
Yeah,
terms of getting into like a collision that causes a total loss of vehicle, right?
for sure. Yes.
Interesting.
Yes.
Yeah, I
Yep.
hadn't
And
even considered that.
yeah, and we might be able to jump into that in a future episode if we do one on a short episode on auto insurance, for example. But with gap coverage, I had bought it, but I had it rolled into our auto loan with the dealer. And so I remember asking myself before I sent in the payment, I was like, wait a minute, I'm paying this off early. Is there any way I can get a refund for the portion of the gap coverage I'm not using over the life
Okay.
of this loan, right? Because like I paid for the gap coverage to be for the entire life of the loan, right? I actually called up Toyota Financial Services, which is where we had the loan with, and they were able to, since I was going to make a payment to knock out the debt, they actually did a pro rata calculation, like, oh, well, you only used it for this long, and you're paying off your debt really early, so we're going to send you a check in the mail as like a pro rata refund for the portion that you're not using for
Nice.
gap coverage.
Yeah,
So
and you
if
only
I
got that because you asked for it.
right, and so if I had just gone and done an auto loan refinance, which means somebody else is paying off the auto loan, they're not going to know that part of that auto loan made up of a gap coverage that I could have gotten a little bit of a refund. And then I might have just missed out on a little bit of money I could have avoided being rolled into this new loan. So anyway, I just spent a lot of time talking.
Such a finance nerd.
I know.
Can't believe it.
I was expecting that to be a very quick call out, but now I'm realizing it was a little more in the weeds than I expected. So apologies to our listeners, but for any of you out there that might be in that situation, that's an interesting nuance to be aware of.
I know we had two more things we wanted to touch on. So why don't you walk me through credit cards, refinancing, and balance transfers?
Yeah. So to our listeners, if you haven't listened to it already, I would check out episode 6, Credit Card Dilemma. We do talk about the pros and cons of balance transfers, but I do want to briefly mention it here. If you have a bunch of credit card debt and you are struggling to pay it off and you're being hit with double-digit interest month after month, you could consider some sort of balance transfer offer where there's a usually 3 to 5% fee on the amount you're transferring that gets rolled into the new balance transfer. And then it'll have some promotional period of 12 to 18 months, usually, of 0% interest. So it gives you some breathing room to not be paying all this interest month after month. It can really save someone's skin in a tight situation and really knock out that interest charge. But you have to be very careful when doing that, because a lot of people will do these balance transfers and then punt it off and just not be thinking about it. And then next thing you know, 12 or 18 months or whatever your promotional period is goes by really quick, and you still have this big chunky balance on there that you've not been accounting for. And once that promotional period ends, the interest charge kicks back in, which is again going to be another probably 20% plus interest rate.
Yep.
So just something to be aware of.
Today's rates probably 27, 28%.
Yeah, that's wild. So be aware of that. The other one, this is slightly unconventional, but if you have family members that are willing to help you, either via family loan or a family gift, that is also something you could consider. A lot of family members like to gift to their children, which could be obviously no strings attached, easy way to maybe knock out some debt that's really bugging you. You could also do a family loan. If your parents, for example, were to do a family loan to you, they'd have to be mindful that the interest rate they're charging you is above applicable federal rates.
That's what I was going to bring up, is that they literally have to follow federal rates for the interest they're charging to family members. So keep that in mind.
Yeah, I mean, if we're being fair here, though, the applicable federal rates, the AFR, they're pretty attractive. They're lower than like debts you're going to get elsewhere, generally speaking. Last I looked.
Okay.
And one way you could look at it is, hey, your family's helping you by giving you a lower interest rate than what your current debt is, so a refinance, if you will. Maybe they give you a nice repayment schedule that also helps lower your payment and give you a little flexibility. And in return, you're also giving your family members an asset class that gives them a rate of return, right? Like they're earning interest on the family loan they gave you. So could be an interesting win-win situation, Maybe you're a new allocation to their portfolio. You're like a bond payment. Right.
Unsecured debt. All this considered, what would you say are kind of the final takeaways for refinancing and kind of debt manipulation in a way?
Debt manipulation. Wow.
Yeah.
I like that.
Making up new words all the time.
Yeah.
New phrases.
Let's coin these terms, the Financial Philosophers podcast definition or terminology, if you will. Some takeaways. Again, we come back to this all the time, Danny, but think about your personal situation, right? Like what is your cash flow? What is your job situation? Is it stable? What is your emergency fund like? Think about your goals. Are you really trying to save on that interest, or do you need to free up cash flow? Think about what options you might have at your disposal. Like explore all of them. Make sure you really consider everything on the table before making a decision. Don't jump into any decision without really making sure you understand what it is and what the benefits are, as well as what the detriments are.
That makes sense.
Think about, going back to the student loan example and those things, think about any specific risks that might pertain to your situation. Like the student loan forgiveness was a good example. Maybe there are costs to refinancing and you have to know when that break even is. Think about your risk tolerance, your spending habits. These are all important things you have to take into consideration. And once you've done that, you're going to have a better sense as to whether refinancing debt and how you choose to refinance that debt may be a good fit for you.
Awesome.
Yeah.
Yeah. Those are all great call-outs. It can get a little crunchy, but it's great stuff to dive into. To everyone listening, hope that you took a ton away from this and that you can approach your debts, whatever they may be, with kind of a new perspective, a new viewpoint, and move forward with some smart decisions regarding those options. But yeah,
definitely.
hope you enjoyed. And as always, have a great week.
Awesome. Thanks, Danny. See you all next time.